Can you believe that San Francisco's office leasing activity is back to pre-pandemic levels? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. San Francisco is experiencing a commercial real estate resurgence, with office space vacancies dropping below 35%. Data from JLL highlights that more than 9.2 million square feet of office space is now leased in the city, marking a return to pre-pandemic levels. This uptick in leasing activity is being attributed to safer and cleaner streets, as noted by business owners who are feeling more secure and optimistic about the city's future. The real estate scene in San Francisco is being likened to a gold rush by commercial real estate brokers at Blattis Realty, who are witnessing an increase in deals, especially in leasing and selling business spaces. Jeremy Blattis of Blattis Realty reports an exceptionally busy period, indicating a renewed interest in areas like Union Square, despite its current storefront vacancies. New deals are on the horizon, including larger spaces like the former flagship Banana Republic location on Sutter Street. Jacob Henson, general manager of Just for Fun, a toy store opening its fourth location in Union Square, credits Mayor Lurie for the city's revitalization. Henson states that the cleaner streets have contributed significantly to the city's vibrant atmosphere, encouraging more businesses and prospects to consider San Francisco as a viable location for expansion. An unnamed realtor from A Vision Young points out that the cleaner streets are not the only factor. There is also a spillover effect from tech-heavy areas like Jackson Square and Mission Bay. The influx of artificial intelligence companies has made a significant impact, with half of the deals in Union Square involving tech firms. This trend is further underscored by Nintendo's decision to open a store on Powell Street, favoring San Francisco over numerous other potential locations. JLL's research indicates that citywide office leasing has bounced back to pre-pandemic numbers, with a notable increase in the presence of artificial intelligence companies. In 2023, nearly 50 leases involved AI firms, and by 2025, over 200 such companies are leasing property in the city. Cell phone data corroborates this growth, showing a 28% increase in downtown foot traffic on weekdays from January 2024 to June 2025. The city's entertainment zones and events, such as outside lands and concerts by Dead & Co., are drawing more visitors, further energizing the local economy. Mayor Lurie emphasizes the importance of these events in revitalizing San Francisco, aligning with the city's status as a hub for artificial intelligence. Anne Taupierre, executive director of San Francisco's Office of Economic and Workforce Development, remarks on the city's new trajectory. She credits Mayor Lurie's initiatives in improving city infrastructure and hosting live events, combined with San Francisco's position as a leader in artificial intelligence, as key drivers of the city's comeback. In a related development, Ross Dress for Less is set to open its second location on Market Street in San Francisco this weekend. The grand opening is scheduled for Saturday morning, adding another milestone to the city's economic revival. Liz Hart, president of leasing at Newmark, shared insights on the current state of retail real estate, suggesting that it is experiencing what she terms a golden age. According to Hart, retail properties are witnessing a remarkable 45% growth in sales, paired with a vacancy rate of just 5%. This combination, she explains, presents a big opportunity for investors and developers in the retail sector. The retail landscape is evolving rapidly, with a significant increase in consumer spending and a corresponding demand for retail spaces. Hart highlights that the low vacancy rates indicate a strong interest from retailers looking to expand or establish their presence in prime locations. She believes that this trend is likely to continue as the economy stabilizes and consumer confidence grows. Drawing a parallel to the Canadian market, particularly in areas like Kitchener-Waterloo, London, and Cambridge, Ontario, there is a similar trend of robust retail growth. These regions are experiencing a surge in retail developments, driven by a growing population and a vibrant tech industry. Retail spaces in these cities are becoming increasingly sought after, mirroring the trends seen in the United States. In the United States, the retail sector's resilience is further underscored by the strategic moves of major players like Simon Property Group. Their recent $1.5 billion senior notes offering is aimed at refinancing existing debt, a move seen as a commitment to strengthening their retail real estate portfolio. This action is perceived as a strategic effort to cement their position in the market amidst the evolving retail landscape. Simon Property Group's recent $1.5 billion senior notes offering is a strategic refinancing move designed to optimize its debt structure while leveraging the robust strength of its retail real estate portfolio. This transaction, which consists of $700 million in 4.375% notes due in 2030 and $800 million in 5.125%. Notes due in 2035 underscores the company's proactive approach in managing near-term liquidity risks and aligning its capital structure with long-term strategic goals. The offering replaces $1.1 billion in 3.5% notes maturing in September 2025, effectively extending the company's debt maturity profile and reducing refinancing pressure. While the new weighted average coupon rate of 4.775% is 1.275 percentage points higher than the maturing debt, the extended terms of 7.8 years provide Simon with greater flexibility to navigate a volatile interest rate environment. This trade-off, paying higher interest to secure longer-term stability, reflects a disciplined approach to risk management. Simon Property Group's ability to execute this refinancing at a time of macroeconomic uncertainty is underpinned by the resilience of its retail real estate operations. As of June 30, 2025, the company reported a 96% occupancy rate for its United States malls and premium outlets segment, a 40 basis point increase year over year. This performance highlights the enduring demand for physical retail experiences, particularly in premium and mixed-use destinations. The refinancing extends Simon's weighted average debt maturity to 7.8 years for these obligations, a move that enhances its liquidity and financial flexibility. With over $10 billion in liquidity and an A-rated fortress balance sheet, as highlighted by Chief Executive Officer David Simon, the company is well positioned to manage its debt obligations while pursuing strategic initiatives such as portfolio enhancement and operational efficiency. The increased interest expense, approximately $14 million annually on the refinanced portion, will modestly impact funds from operations. Investors should weigh this cost against the benefits of reduced refinancing risk and the company's strong operational performance. The offering also provides flexibility to allocate remaining proceeds to general corporate purposes, including the repayment of other unsecured indebtedness, further strengthening the balance sheet. Simon Property Group's refinancing strategy aligns with broader trends in the retail real estate sector, where operators are prioritizing debt maturity extension and liquidity preservation. The company's focus on premium locations and tenant diversity positions it to weather economic cycles, making its debt profile more attractive to investors. For investors, the key takeaway is that Simon's proactive approach to debt management reinforces its long-term stability. While the higher interest costs are a near-term drag, the extended maturities and strong operational metrics suggest a resilient business model. The offering also demonstrates confidence in the company's ability to execute its strategic vision, including the integration of e-commerce and experiential retail elements into its properties. Simon Property Group's strategic refinancing is a testament to its financial strength and the enduring value of its real estate portfolio. Investors should view this as a positive signal for the company's long-term prospects, as it underscores Simon's commitment to prudent capital management and positions the company to capitalize on the evolving retail landscape. Investment in New York City's commercial real estate sector has reached a remarkable $13 billion in the first half of 2025. According to Ariel Property Advisors, over half of this investment is concentrated in what they refer to as the fabulous four asset classes: Class A and trophy office, free market multifamily, affordable housing, and retail properties. Class A and trophy office buildings have been a significant focus, accounting for 74% of the $3.1 billion in office sales during this period. This surge in sales represents a 116% increase year over year. Investors, including private equity and institutional players, are drawn to these properties due to the premium rents. High-credit tenants are willing to pay for well-amenitized spaces. Companies such as Deloitte, Jane Street, and Apollo Management have leased nearly 3 million square feet in these prime locations, contributing to a substantial drop in vacancy rates from 17.2% to 10.7%. In the multifamily sector, sales rose by 5% year over year to $4.4 billion, with free market properties making up 57% of the dollar volume. Manhattan and Brooklyn were major contributors, generating 95% of the free market dollar volume. The consistent rent growth and undersupply of housing have pushed vacancy rates to just 2.25%. This trend has encouraged investors to focus on new or 421 properties, as well as deregulated and tax class protected buildings. Affordable housing remains a critical component, accounting for 20% of multifamily dollar volume. The demand for affordable housing is driven by high demand and limited supply, coupled with public incentives. The largest sale in this category was Treadway's acquisition of a 602-unit property in Far Rockaway, Queens, for $88 million. This deal underscores the strategic and infrequent nature of affordable housing transactions, which often require capital reinvestment and renewed incentives. On the retail front, sales reached $1.3 billion, with high-end locations being particularly attractive to quality brands. Notable transactions included Uniqlo acquiring its flagship store at 666 Fifth Avenue for $355 million, and Ralph Lauren purchasing its flagship store in Soho for $132 million. These purchases highlight a trend among retailers to secure long-term control of their locations to avoid future rent increases, demonstrating strong demand for prime retail properties. Overall, the investment activity in the first half of 2025 illustrates a market characterized by a flight to quality. Across office, multifamily, and retail sectors, investors, lenders, and users are making strategic, long-term bets on premier assets, confident in their enduring value. The prevalence of complex partnerships and recapitalizations signifies a deep-seated belief in the future of New York City's top-tier properties. Commercial real estate lending is showing signs of a strong rebound in the second quarter of 2025, despite ongoing challenges in the market. According to research from CBRE, both banks and alternative lenders have been actively involved in supporting this resurgence. However, caution remains due to government policy and economic uncertainties that are impacting Treasury yields. The CBRE Lending Momentum Index, which measures the pace of CBRE-originated commercial loan closings across the United States, saw a significant increase of 45% year over year. Although there was a 6% decline from the first quarter of 2025, this was attributed to tariff announcements and policy uncertainties that affected borrowing conditions in April and May. Nevertheless, the index rebounded robustly in June, closing the quarter at a value of 275, which is well above the 5-year pre-pandemic average of 229. In the second quarter of 2025, commercial mortgage loan spreads widened to an average of 193 basis points, which is an increase of 10 basis points compared to the previous quarter. This widening of spreads reflects the caution among lenders and the influence of external economic factors on the lending environment. The resurgence in commercial real estate lending indicates a strong interest from both traditional and alternative lenders, despite the challenges posed by economic and policy factors. This trend suggests a resilient market that is adapting to the current economic landscape, with lenders seeking to capitalize on opportunities in the commercial real estate sector. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.